My name is Carl Siegling. I am Chairman of the Board of Directors. On to the presentation then. The first slide should look familiar to most people in the audience and to people that are receiving the monthly newsletter. We present our performance in this format on our newsletter, which is gross performance. We also show post-fee performance. We show post-tax performance. We've made a determined effort to show the performance in as many formats as people want to receive them. If you'd like to receive it in another format, please let us know. There's 4 formats there. We might be able to put in a 5th. The performance, and really the thing that I always find interesting in the period that we've been running a company, because of course when you start, who knew 7 years ago what the future held, and who knows now what the future holds 7 years from now. But one thing we can say about those times is in the bottom line there, that the last period of 7 and a bit years now, the All Ordinaries Accumulation Index has produced a 3.73% gross return. That is not a high return for an equities market to produce. And it is an interesting period in that it is a lower rate of return than you could have earned in the bank. So we find ourselves in a very interesting point in history, and I've reflected on that in our presentation and many of the slides to follow, to try and position that kind of very poor return from the overall index. And if you had bought into the All Ordinaries Accumulation Index, you may not have even got that because you would have had frictional costs. And then we're pleased to report that our numbers have been significantly higher than the 3.73%. And we have done that holding levels of cash within the portfolio on average of 24% cash during that period of time. This is the second format in which you would find our returns presented in our monthly newsletter. And that is a CDM share price plus dividends compared to the All Ordinaries Accumulation Index. I think there's been quite a lot written about this kind of comparative performance over the last year or two as people begin to realise that the All Ordinaries Accumulation Index is not necessarily a post-tax return number. If you invested and you earned your 3.73%, depending on when you'd bought and sold, you would have also had to pay tax on that. Alternatively, you would have received some dividends from that All Ordinaries Accumulation Index, and they would have been fully franked. The numbers that you see there for us are our 1, 3, and 5 and numbers since listing, and do not show the franking that you would have received from dividends from Cadence Capital Limited. And of course those dividends have been, as we will come to now, substantial, and the franking on those dividends have been substantial as well. This is a slide taken from the ASX website. It ranks all the listed investment companies in Australia, and we're one of those companies. We've done 34.9% return for 3 years, 10.8% return for 5 years. Interesting, when you look at those 5-year numbers, we go from 10.8, 9.1, 3.7, 2.4, 1.9, and those are the top 5 LICs. There are a lot of LICs listed on the Australian Stock Exchange, and you pretty quickly get down to a situation where they have found it very difficult to produce a return over the last period of time. And understandably, the market's delivered 3.73%. It's been a very, very difficult investment period. I would caution when looking at those 3 and 5 year numbers, the same statement I said before. Those are numbers that are a post-tax number. They don't reflect the franking that will have been received on dividends. That's not measured anywhere in these performance tables. No one measures the additional franking that you receive as an investor in the fund. These are some slides that hopefully, if you're getting our monthly newsletters and quarterly webcasts, you may have seen before. These are rankings of the return of our fund against the All Ordinaries Accumulation Index and a number of other funds. Those are the 5-year numbers against other funds. Interesting there, if you look at the accumulated return of the All Ords over 5 years, it's actually a negative number. Extremely unusual period for any equity market at any time in history. And this is the third method that we're starting to show shareholders in terms of performance that they may have received from investing in Cadence Capital Limited, which is ordinary interim and final dividends, as well as special dividends. I would caution once again that these numbers do not include franking. Franking is a very important component of the overall return that you receive as an investor. Particularly true of people who own their investments in the self-managed super fund, and particularly true of people who are coming to what we call the drawdown age or the 60-plus age, when in actual fact you don't pay any tax on your investments, which means you would get that return plus all the franking that we've given you returned to you by the Australian Tax Office. This is just another way of portraying the dividend yield, but once again doesn't include the franking. So of course, and these are all bits of information put out by different analysts and different people, and they show a piece of the puzzle. And this is the slide that I wanted to alert everyone to in terms of what shows up in our financial statements, which, I mean, often we don't get down to note 27 or whatever the note is in evaluating the investment. The accumulated franking and profit reserves provide relative certainty for our business. Within our notes, you will find a section showing the franking and the accumulated profit reserves, and they indicate that our company isn't. If you can look through those numbers, you would see that we're in a relatively good position to pay interim and final dividends going forward, and potentially a special dividend. We have accumulated significant franking credits, allowing the payment of approximately 22 cents of fully franked dividends from now on, before we earn any future profits. We also have a large tax asset balance. What does that mean? That means we can earn, and this is again a note to the accounts, the CDM can earn approximately 10 cents of profit per share before any future tax is payable. So every month when you receive the pre-tax number and the post-tax number in our newsletter, you will look at it and say, that's the pre-tax, that's the post-tax. What's not reflected in those numbers are these two assets, which are in the notes to the accounts. And the company's stated dividend policy, as we've been saying now for a considerable period of time, is to have a continuous and growing dividend stream over time. We paid 4 cents interim and 4 cents final this year, plus additional specials. And next year, I would, as manager, our team as manager would go to the board and say, well, we're looking to grow that income stream, the interim and final dividend. So, our starting point may be, for example, I would ask the board to consider a 4.5 cent interim and a 4.5 cent special before any special, 4.5 cent interim, 4.5 cent final dividend before any special dividends get paid. Significant for the company this year has been that our options expired, but were mostly exercised. 98% of them were exercised. 2% of them were not exercised, unfortunately. So there are 2% of options out there that expired worthless with a strike price of $1.25 on today's share price of $1.43, and they've missed out on 8 cents of dividends and another 4.5 cents of franking. So unfortunately, that does happen from time to time. We went out of our way to call all of our shareholders. We've called some of them 2 and 3 times. Unfortunately, sometimes with the disintermediation between the end owner of these shares and the management team, we weren't able to get hold of some of them. Of course, we do like, and I hope everyone here has at least been contacted in some form. We like to be in contact with our shareholders. One of the advantages of owning a listed investment company is that we hope that we're bypassing a lot of those intermediary steps, that you as an investor get to talk to me. I'm the manager, and that you as an investor, if you have a problem, you can call us and we can resolve that. We want that to be an ongoing and continuous feature of the business. If there is a problem, if in the future you have any problem with an option or the strike price of an option or paperwork or anything like that, please call us. We're trying to be the interface with your investment. On the 24th of September, we placed $11.4 million of stock at $1.37 per share. And I think you probably would have read that we were oversubscribed on that placement. And I must say we were rather surprised at how quickly that was filled and how significant the oversubscription could have been. In the end, we had to close it early because we'd been oversubscribed. Since last year, our shareholder base has grown from 508 to 1,016, which looks like exactly double shareholders in total. And we're very pleased with that. And many people in this room, one of the problems you would have seen us live through is that in the good times, the shares went to a premium. In the bad times, you go to a significant discount because there's a loss of confidence in the marketplace. There's not enough liquidity. There's a loss of bid and offers in the screen. And as your shareholder base doubles, we hope that liquidity improves, and we're seeing that it has improved significantly. And also that those extreme points of negativity and extreme points of positivity, we hope over time that balances it out a bit. And we've also noted a number of times now that a number of our new shareholders are self-managed super funds, which in a way comes back to that point again where we see a lot of people in the community not relying on big managed fund organisations or traditional houses to manage their money, are now taking control of their own financial destinies, managing their own self-managed super funds. We've seen self-managed super fund grow from 5% of the asset pool to 35% of the asset pool. And for those people to invest their money for their benefit and talk directly with the manager. And that is exactly what we hope to achieve. You are invested with the manager, you're invested with us, you're invested alongside our money. So that outcome is starting to be realised. What's gone well for us this year? The sectors that have gone well have been banks, diversified financial software and services, and energy. RHG in particular, Macmillan Shakespeare, Flexi Group, Bravura and CTP. And the things that have gone poorly for us have been capital goods and the materials sector, but more specifically in the materials sector, the mining services sector. And I must say that, particularly me, I hold myself accountable for the mining services call. We own 2 or 3 of these mining services calls early in the year. My prognosis was that yes, the resource boom was over, but that didn't mean that we weren't going to continue to take the minerals out of the ground and send them overseas, and volumes would still be maintained. But gee, these mining services companies have been hit as hard as the resource companies, if not harder, and that simply was simply just poor judgment. And what does that mean in terms of our investment process? That means when you've made a mistake, the very worst thing you can do when you make a mistake is not acknowledge it and double up to catch up or triple up to catch up, or say everything, or that's the worst thing you can do. The second worst thing you can do is bury your head in the sand and say, oh, don't worry, it'll come good. Then really what you should be doing, or said what we believe you should do, is if you've made a mistake and the stock rolls over and starts to come down, you sell a third of it, then you sell another third of it, and then you sell another third of it. So you feel pain, you feel some pain, you live to fight another day, you live to talk about it at the AGM, and next year you can talk about the other mistakes you made at the AGM, but you get to see your good stocks go well and improve. And really I think that is a feature of the way we manage money, actually a very important feature of the way we manage money. If we make a mistake, we have to be upfront, acknowledge we've made a mistake, start to exit the position as soon as practical or possible. We'll go into these stocks in a bit more detail later. Just on the general environment now and what we're actually doing, we've overlaid there the All Ordinaries Accumulation Index against our portfolio exposure, and you can see our exposure going up and down. That's really what we're trying to show there. In good times, when we wrote the prospectus originally 7 years ago, we took the very simple notion that in good times, you want to be long stocks. In bad times, you want to be out of stocks or selectively short really bad stocks. And in benign periods of time when you're not sure what's going on, you want to be good long stocks and short bad stocks. And to the extent that you can't find either, you've got to be holding cash because the opportunity will arise at some stage to either find a good stock or a bad stock. And that's what that reflects. That reflects the changing exposure in the fund. And of course, the points at which you need to be exposed in the cycle or exposed into this period are exactly the opposite to how you're feeling at the time. That period, March, April, May 2009, you would have been congratulated at your cocktail parties for saying we're in cash, we're 100% cash, yeah, we've got out, we're feeling good, the market's a mess. No sooner had you congratulated yourself than the market went up 50%. Then you've seen the market meander around, come up and come off, and right now you're not going to get in trouble for going to a lunch where you have to present your views and you say, oh, it's a very uncertain environment, oh, it's unsure, oh, it's bad, yeah, no, it's Yeah. And you know, that's the environment we're in now. And as soon as we're all agreed that it's an incredibly uncertain environment and we don't know what to do, something's going to happen and that's going to change. So as sure as we're standing here right now, this environment probably won't be the same a year from now, or 2 years, or 3 years. And that's it. That's it in another format. I put this in last year, and I've only updated it. What's fashionable and trendy? On the way up, it was trendy to be leveraged long only, 130/30 property trusts, infrastructure trusts. That was the kind of stuff you wanted to own. That was the good stuff. That's where you got the rewards at the cocktail parties, the nods and the grins. Then when it all went pear-shaped, you got rewarded for saying, oh, we're in cash. Yeah, we're looking at market neutral funds. We're looking at these buy right strategies. We're looking at these, like this, something slightly funkier. And then you got destroyed on that too, because the market then rallied 50%. Then to migrate, I don't forget, I went to a presentation with a group of financial planners and listed investment company managers, and there was a big square table. There were lots of people there. There was about maybe 80 people there, and we were all discussing the pros and cons of these different things. And all the planners were saying, well, it's all about exchange-traded funds. It's all about low cost. It's all about being long the index because the managers can't perform. They don't know what they're doing. And so, we've got to get low cost. We've got to be in there. We've got to have the low cost. It's got to be exchange-traded. It's got to be all of that. And then everyone agreed. That sounded fantastic. And so then what happened is they had 20% volatility for the next 4 years and no return. So now they're scratching their heads saying, well, hang on. Why didn't that work? Well, what it comes down to is it's about picking stocks. And it's about having a strategy that you use consistently. It's not really about using 130/30 longs when it's exciting or leverage long when it's exciting. It's not about being market neutral when it's exciting. It's not about being in cash when it's exciting. And it's not about being in exchange-traded funds when everyone agrees that it's a good time to be in it. It's actually about picking stocks. It's about picking cheap stocks and owning them, and it's about shorting expensive stocks. And when you don't know what's going on, you've got to hold cash. The only thing that I liked in those discussions from 2 years ago was dynamic asset allocation, which is this big word that everyone was starting to use to try and get around all of these problems. Because when you retrospectively looked at how badly all of that strategy had performed, you'd say, no, what we really need is dynamic asset allocation. We need to dynamically be asset allocating all of this stuff. And we agree with that, but we agree with it in a different way. We agree that you have to be dynamically asset allocating your stocks and cash every single day based on how every single stock in your portfolio is going every single day, or evaluating it and moving into and out of stocks and positions as you go. We don't believe philosophically as a house that you can pontificate on how small caps are going to go right now for the next 3 years. We don't believe you can pontificate or have a view on what resources are going to be doing right now for 2 years' time. I actually increasingly don't believe that spending too much time speculating on what the future holds is particularly useful. I think you could spend a lot more time visiting companies, looking at stocks and finding out how they're actually going, as opposed to how you think they're going, and working out what their cash flow is, how their earnings are growing or decreasing, and how strong or weak their balance sheet is. And we're going to be spending our time doing that. We won't be spending too much time speculating on what the future holds. And just when we were doing this yesterday, I said to Chris, can we just put in 3 red lines to show additionally what we're actually dealing with here? The market's been between 4,000 and 5,000 for the last 4 years, and actually is halfway between 4,000 and 5,000 right now. We're halfway between those 2 points. So if you do sit here and speculate on where you think the market's going to be, for simplification of the process, I do it internally and I say to people, it's going to trade between 4,500 with a midpoint of 4,500. And when it goes up 2%, people are going to get excited, and when it goes down 2%, people are going to feel terrible. So that's that, and now let's get on with our jobs. The S&P Resources Index, that's what's actually happened. Not what people are telling you, and not what the newspaper's saying. When is the resource boom going to end? When is the resource boom going to end? What have we done? What haven't we done? What's actually happened is that the resource boom has already ended. So right now, the resource index is meandering lower, and that's what we can actually deal with right now. So all the speculation in the press and politics and that's happening is really just a consequence of the fact that the resource boom has ended. When I say the boom has ended, I mean the boom part of the resource boom has ended. I'm not saying the resource sector has ended in Australia. There's always going to be a resource sector in Australia. It's just going to have normalised profits, not super normalised profits. So, and the banks, what's actually been happening with the banks? That's actually what's been happening with the banks. They went through a period of, not so much here, but overseas, of near-death experience, and since then have been recovered. And banks are sometimes a proxy for the reverse of interest rates. And so, as interest rates have come off and yields have gone up, the banks have improved a little bit. That's what's actually happening. Why do I show these two charts? Resources and banks make up a very big portion of that guessing game, trying to guess where the All Ordinaries Accumulation Index is going to be. They make up a huge proportion of that guessing game. And this slide is confounding me, so I wanted to put it in. This is, there's two continents here that are being reported to be doing pretty badly, and there's one that apparently is in good shape. But you'd be hard-pressed to guess which one they were from the chart. The one that's been doing particularly badly is the American continent, and that's the S&P 500, and that's at all-time highs just about. The one that's reputed to be doing second worst in the game is the European Combined Index, which has done marginally worse than Australia. But if you take out Greece, Spain and Italy, the offenders, so to speak, that index would be significantly higher than Australia. And then you've got the other continent, which has done really well and doesn't have any debt and has been in great shape, and its stock market has done, well, not particularly well, quite poorly. It's actually done very poorly. And we can and we can all jump to the reasons why that is, but it doesn't detract from the fact that the continent in good financial shape has performed poorly, and the continents in poor financial shape have performed well, from a stock market point of view at least. This is just an update from last year. I thought this was interesting as well. I remember when we were worried that America had $2 trillion of debt, and there was a subprime crisis and a GFC and all that stuff from 5 years ago. Then we found out it was actually 8 trillion, not 2 trillion. And then actually last year we read that it was 14 trillion. So we wrote in that it was 14 trillion, and we were trying to speculate on what it might be next year. And we were wrong, because we said it might be 15 trillion. We just put it up by the interest rates, but actually it's come up to be 16 trillion. And next year we're speculating that it's going to be 17 trillion. And now we're slowly as a group getting a handle on the unfunded liabilities in America as well. And that's somewhere between 65 and 70 trillion dollars. So you've got the unfunded liabilities, 65, 70, and you've got the actual debt of $17 trillion. So if you're in any doubt about whether the American debt situation has been resolved, you needn't be. It has been resolved. Then there's this European issue, their debt. And we were trying to add up all the European debts the other day. I mean, it's very difficult. You get a lot of contradictory data, and basically the number we came up with is it's at least 17 trillion. So between them, they've got at least another $17 trillion of debt. People are just concerned about Greece, Italy or Spain getting moved out of the euro and what that might do. I mean, for my part, I think Greece, Italy and Spain, if they exit the euro, they'll still exist. So the countries will still be there, the people will still be there, but they'll be out of the euro. So
what's the unfunded debt in Europe?
I couldn't work it out in the time I had to put this. Sorry, the question was what's the unfunded debt in Europe, and I couldn't get the numbers together quickly enough. By next year's AGM, I'll have it together. I mean, we know that it'll be double. Yeah, it'll be double. It's very much associated and correlated to the ageing population and what you've promised the ageing population as a retirement benefit, and also what that ageing population expects as a retirement benefit and what they've actually put in. So, if you put those three things together, it's a very big number. So where are we actually with Greece? GDP has declined 6.9%, unemployment's gone up. Youth unemployment's at 48.1%. Imagine being a youth in Greece trying to get a job. So things are not good there from that point of view, from those numerics. And this is the last piece of another piece of the puzzle. fixed interest, or the interest rates. So the lower interest rates go, the higher fixed interest goes. You know, the inverse relationship between the bond and the interest. And, you know, if you're looking for a bubble, what you want to see, things pushing towards the zenith. You know, as interests the lower and lower they get, the closer you are to a bubble in fixed interest, the closer you are to the ending of it all, you know, to a reversal, not the ending of it all. It's just a reversal. It's just cyclical. Everything is cyclical. So, you know, with this kind of 2%, 3%, 4% interest rate very, very quickly leads to the next piece of academic discussion or hypothesis, which is negative real interest rates. And then judged on this chart here, America is already in negative real interest rates. And we know that because Norway, the Scandinavians are paying the US government money to keep their money in American bank accounts at the moment. So they have to pay them $50,000 a month for a big institutional wad of money to keep it there. The government said, if you want to keep it here, you've got to pay 50. So they're doing it. So they're in negative real interest rates. We are slowly meandering now towards negative real interest rates. And I would argue personally that I already feel in negative real interest rates. If I put my money in the bank at 4.5% and I pay my tax, I'm left with, you know, 3.5%. And when I go to pay for things, I feel like they're up more than 3.5% compared to last year. Now, I know that's, you know, I'm told by the government that the CPI is running at lower levels than that, and I accept that if I go and buy Billabong board shorts, they're cheaper this year than they were last year, and maybe if I go to buy a new car, they're cheaper than they were last year, but I'm not buying a new car. I'm paying for my registration, I'm paying for food, I'm paying my electricity, I'm paying my gas, I'm paying for water, and all of those things are going up at 15% per annum. So on that basis, I'm going backwards pretty quickly having my money in the bank. So having your money in the bank in a period of negative real interest rates does not work unless everything else goes cataclysmically wrong. Another way of saying this is you can't retire on negative real interest rates. So if you're feeling confident and comfortable about living in a period of negative real interest rates and just having your money in the bank, maybe it's a very unsettling period in history. But then you've got the issue, if you know, having just said that, I understand the other side of the argument. If you're staring at what they're calling now, the trendy name for it is the fiscal cliff. Like if you've got the fiscal cliff, and let's say you know about the fiscal cliff, and you were really nervous about the fiscal cliff in America, I just keep using the word fiscal cliff. So then what you would have done is you would have stayed in cash, and then so you were worried about the fiscal cliff. So then you know, you stayed in cash. So now the market's up 100% since then. So your fiscal cliff analogy didn't work. But maybe it might work in the future. And why do I say all this? Just to illustrate how uncertain the environment is at a macro level. And so if you sit there, like, you could just go in circles. You just go in absolute circles and you just get nowhere. I can't stay in cash in a negative interest rate environment. I can't invest in a fiscal cliff environment. I can't buy resources. The boom's ended. Okay, banks are up here. They're giving a good yield. But if the fiscal cliff comes to pass, banks will be worthless. So it's just a circle. It doesn't actually get you anywhere. But I'll come on to where I value to be added in the whole equation. None of this so far, by the way. So what do I think? I think that we're going to continue doing exactly what we've been doing for the next 7 years. We're going to keep visiting companies. We're going to try and find the cheap ones and the expensive ones. We're going to look for stock-specific opportunities in industry-specific situation. The macroeconomic environment is going to be as uncertain and ambiguous. We spoke about this last year, and we think this will continue this year. Index tracking strategies will continue to experience volatility with little or no return. We said that last year and the year before, and we think that'll be the same next year. Investments designed to guess where the All Ordinaries Accumulated Index will be at the end of 2013 should continue to struggle in this environment. In fact, any investment designed to guess where the All Ordinaries Index is going to be at any point in the future should struggle. That's the nature of gambling. Gambling is a struggle. We're not here to gamble, per se. So I'm not here to gamble with my money. I'm not here to gamble with your money. But there are strategies out there designed to do this type of thing. The current poor returns in Australian equities will not continue indefinitely. What an easy thing to say. I don't know when it's going to change, but it won't be like this forever because money doesn't work like this forever. At some stage, people say, I'm not prepared to take 3.7% return, taking this much risk for the next 5 years. And at the very point that they say that, they take the money out of the equities market and the market delivers 13.73% return for the next 5 years. But that's how it works. Not everyone's going to make money in this environment. Someone told me this morning that an overseas researcher had come to Australia and done research on all the funds management businesses in Australia, and the shocking revelation that they came to was that 38 out of 1,000 companies had actually added value in the investment equation. And I was quite surprised at that. Like 40 out of 1,000 had added value. That's 4 out of 100. That's 4%. That's pretty high. You know, like of the companies that I look at, there's 2,500 companies listed in Australia. Only 700 of them made a profit last year. And of those 700 that made a profit last year, there's only a handful of them stock price would have delivered a return for you. So I say that there's less than 4% of the stocks on the Australian Stock Exchange that could have delivered you a reasonable return last year anyway. So then you have to get the combination of the 4% that actually would deliver a return and those managers trying to pick them. And if you can get those two right, I was surprised that 4% had added any value. That seemed like a high number to me. Okay, that was poor returns. And cash could be a risky investment if real interest rates turn negative. And what do I mean by that? It's simple. You know, the guys in cash, he wants to, I hear that private banks say this quite often. The object of our bank is to preserve and grow your wealth. And then the issue is, which one is it? To preserve your wealth or to grow it? Because we can, in theory, you could preserve someone's wealth or grow their wealth. They're two different things. If you say you put it in the bank, you put $1,000 in the bank and real interest rates are negative 3%, you won't have $1,000 in the bank at the end of the year. You'll have, your buying power of your $1,000 will be 990 or something. It'll be lower. So if you keep doing that, if you keep preserving your wealth, you're going backwards. And you know, we could be in for a period of that unless you're actively invested in things that can benefit in an environment of low interest rates and in an inflationary period. Unless you're invested in the right stocks, you will be going backwards. And then, of course, there's this last one, that fiscal stimulus in many regions of the world has boosted stock market performance. Now, that's worked in America, it's worked in certain parts of Europe. They do it in different ways. By keeping the euro low, the powerful nations in Europe have made extra super profits, exporting Mercedes-Benzes to China and BMWs, and even parts of the engineering communities in Italy, Spain, Germany, Scandinavia are making super profits with such a low euro. The only poor people suffering under this scenario of this exporting of the currency, creating the strong currency, would be in a country like Australia, where you've got such a strong currency, you're getting crippled. Your equities market is just not going anywhere. I mean, you know, what do? You have some fiscal cut interest rates and you can really have some price and equities explosion. If you get interest rates low enough, we could have an exploding equity market. If you get interest rates low enough, we could have a monumental rise in property prices, and you know, we could do all that. That's what people overseas are doing. But you know, we're aware of the dangers of that. I'm just saying that other nations have chosen to do that. And that's all. That's basically the environment that we're living in. I would point to the first one again. We will continue to do what we're doing and look for undervalued stocks. And they are around, they do exist. And the more uncertain the environment gets and the more fatigued everyone gets, the less people are working in the industry. As people lose their jobs, there's less people looking at stocks. And as people lose their jobs on the prop desks at UBS, there's less people doing dividend arbitrages and convertible note arbitrages. And eventually, when there's none of them doing it anymore, you make fantastic profits doing that type of thing. Unfortunately, there's too many people doing that at the moment, and you don't make a good risk-adjusted return. But that's all changing. That will all change. We know that UBS is getting rid of 10,000 people over the next year, and that gets rid of 16.6% of the financial services workforce in one of the largest financial services companies in the world, and that will be happening across the. And so that creates a whole wealth of new opportunities, and it's you know, I keep coming back to, I think I said it a year ago and 2 years ago, we feel like we're in that 1968 to 1978 period. There was a resources boom, then a resources bust, and then an interest rate, and a lot of really unusual things happened during that period, and the stock market went up and down for 10 years, and it ended up exactly where it started 10 years later. So from 1968 to 1978, the market went nowhere, and then it had a huge rally. But a lot of people in that period, and a lot of astute investors, made names for themselves during that period. They were buying cheap stocks, good stocks, and they were staying away from bad stocks. And they made really, really good returns during that period. And they went on to make phenomenal returns when that period ended and the market went higher. And so it feels like it's going to be one of those periods. And then, and now just this is the point I hope we're going to get to a bit soon. I've been rambling on a bit. And that is stocks. So these are our top stocks at the moment: RHG, Macmillan Shakespeare, Reckon, Flexi Group, Bravura and Macquarie Group. And then there's all the other stocks. And at this point, I'd just like to invite everyone, if you've got any questions about any stocks or any thoughts on what's just been presented there, because I'm sure that there would be a lot of people that would agree or disagree with it, and so there should be in uncertain